Welcome back. My name is Arya, and I don't waste your time, so let's get straight into it. As you might have read by the title of the video, ASML, the stock, is cheaper than a sack of potatoes. And of course, I don't mean that literally, because ASML is a company that boasts roughly a 200, maybe $250 billion market cap. But as you'll see, as we go into the analysis here, and we kind of look at the numbers and the fundamentals of the business and the earnings that the company has produced and is expected to produce, you'll kind of start to realize just how cheap this company is, especially when comparing it to the historical averages that this company generally tends to trade at. Now, with that being said, quick shout out to FinChat.io for sponsoring this video. We're going to hear from them later on. Now, for those of you who are not too familiar with the company, or you kind of know that it's a semiconductor business, you don't know exactly how it fits, the quick, maybe 30, 45-second pitch that I could give to you about the company is that they make these things called lithography machines, and they're effectively the most efficient, the best company that's suited to make these lithography machines. It's the so-called choke point of the semiconductor industry because they're almost, or in some cases for the leading edge machines, they are the sole monopoly provider of these machines. Each one of these costs anywhere between $150 to $400 million on the high end. And so ultimately they sell these machines to their customers such as Intel, Samsung, TSMC. And this is really the enabler of almost all technology innovation in the world. So like, you know, the end chips that come out of these machines would be your NVIDIA H100 chips or the Apple M1, M2, whatever the Apple chips are, so on and so forth. But of course, on the lower end, you know, they make calculator chips and like components for like cars and that type of stuff, fridges and like kitchen electronics, that type of stuff. So they really do have their hand all over the place. The important thing to note with this is that like in the process of baking a cake, this is kind of like the oven. So they make the oven for the semiconductor industry. And so with that being said, just full disclosure, I currently own about 13% of my portfolio is in ASML. I've been a long time bull for this business, and I think it's a phenomenal business. And then additionally, we're not going to really cover the qualitative aspects of the company today. I've done the video, which is on screen now. It'll be linked in the corner, and then I'll also put it all the way at the end of this video if you're interested to watch me sort of dissecting the company's moat and why it's a very powerful business, that type of stuff. It's the most popular video on the channel, and rightfully so. Anyways, with all that being said, let's dive into why the company is cheaper than a sack of potatoes. And so on April 16th, which is roughly, I think, 4 or 5 days ago, the company released their earnings. They're one of the few tech companies that released their earnings a little bit earlier on, and it was mostly business as usual. Things came in line with expectations, and ultimately, this is a company that benefits from very massive secular tailwinds. Any given quarter, up and down, they're going to miss their revenues or beat their revenues. It doesn't change my thesis with the company at all. I'm ultimately investing in this company because I know for a fact 10 years down the line, the demand for semiconductors is going to be significantly higher than it is today, and ASML is a business that is going to stand to benefit from those secular tailwinds. And so with that being said, I'm not going to spend the next 10 minutes dissecting each slide in the investor presentation. I'm not going to read you the earnings per share decimal points. You could go do that in your own free time. What I am going to point out with the earnings, and the only thing that really struck out to me, was the guidance that they gave. So I think the only reason the stock sold down roughly maybe 7-8% had to do with the wide guidance that they reiterated. So on the low end here, you end up with about 5% revenue growth. And on the high end, you're looking at, I think, about 20-25% revenue growth for the year. And then again, on the earnings call, if you listen to that, the CEO and the CFO, they were kind of vague with their answers and a lot of I don't knows. I'm not sure how the macro environment is going to look. I'm not sure how tariffs will impact our business, that type of stuff. So I think that just that general uncertainty with the business, that's ultimately the reason for the sell-off. And I think it was either the day of or the night before, something like that, the NVIDIA H20s got banned. And these were, by the way, if you're not familiar with this, the US government, I think a couple years back, I think maybe 2022, they basically banned NVIDIA from selling their leading edge chips to China for, you know, geopolitical reasons and whatnot. And so these H20 chips were sort of the scaled down version of those chips that were sort of cleared to be sold to China. And so the US government restricted or otherwise banned NVIDIA from selling those chips. And so I think the fact that these were banned kind of created an extra layer of uncertainty to ASML's business because they also have a decent amount of China exposure, albeit, again, ASML isn't able to export their leading lithography machines into China. So this creates that extra layer of uncertainty where it's like, oh, if out of the blue, NVIDIA can have $6 billion of their revenue slashed, what's stopping from the US government from further adding restrictions to a company like ASML as well? So anyways, with all that being said, to kind of put some numbers behind the madness, we're going to go over to FinChat.io, which is the world's greatest stock research platform. And if you watch any of my videos regularly, you know that I absolutely love using FinChat, and I basically use it every single day. They have a beautiful charting interface where you're able to bring in fundamental metrics of your choice. Additionally, the real differentiator of FinChat.io is the segments and KPI section. where you're able to bring in a variety of different company-specific metrics. So for example, in our case, something that's very important to track for this company over time is, for example, the total EUV net system sales. And so you remember when I was telling you about those leading edge lithography machines that they make? You're able to, on finchat.io, track the specific revenue just coming from those machines being sold. And the KPIs don't stop there. You can also pull in different segments. For example, we could bring in the services and field operations revenue. So this would show you how much money they're making from software and services and that type of stuff. And another interesting feature that finchat.io provides is being able to pull revenue by geography. So the aforementioned China risks that I was just talking about. And of course, this number on its own is kind of meaningless. So we could click on this common size button, and right away we could see that at least in the year 2024, China made up 36% of ASML's revenues, which by the looks of it is leaps and bounds above historical averages and where that figure has been over the past decade. So maybe something to look into to see maybe that's just an anomaly, maybe that's just for the past couple of years, so on and so forth. I say all this to say, FinChat's breadth of data is truly one of a kind, and as long as you have a valid email address, so you can get 2 weeks free of the highest tier FinChat Pro subscription using the link in the description down below, and then if later on you want to upgrade to a paid plan, you also get a 15% discount on that front. I really do want to hammer this point in. You have absolutely nothing to lose, and you get access to this beautiful stock research platform. And so with all that being said, in terms of the actual risks to this business, and perhaps part of the reason the stock actually sold off, the China revenues, without a doubt, that's above where historical levels of their revenue is derived from. But at the same time, as I talked about this in a previous video, using another beautiful feature of finchat.io, if you go over and ask Copilot about ASML management's expectations of China revenues, they talk about how it's abnormally high during 2024, and they expect that it'll normalize to about 20% of total revenues by 2025, which is of course this year. And the reason why it made up such a high percentage of the revenues is because they were working through a backlog of Chinese orders. And at the same time, in 2024, there was increased speculation about potential export control restrictions that could impact future sales to China. And so they were kind of working through these two different things, trying to maximize the amount of shipments over to China, because they knew that there's probably an increased likelihood that they won't be able to send lithography machines to China, or at least there's going to be some restrictions on the lithography machines and they won't be able to send that in the future. So again, I kind of want to paint the picture of like, fundamentally, there's nothing wrong with the company. The only thing is that there's increased amount of revenue coming from China, which the reason that deserves a discount is because they're prone to more restrictions. But at the same time, management, which we have no reason why we shouldn't trust them, management said that that should normalize around the 20% range for 2025. And, you look back, I'm going to toggle on common size again here, and you look back and historically, it's been south of 20%. At its peak in 2018, it was about 17%. It's only been the past 2 years roughly where they've sort of accelerated these shipments over to China. And so ultimately, the picture I'm trying to paint here is that this company is fundamentally sound as ever. The moat is impeccable. There's no reason to doubt the moat of this company. They're producing their EUV machines. They're the only company in the world that can still produce EUV machines at scale. There's a caveat to that. In theory, some of these Chinese companies. We'll watch a clip of a YouTube video after this, but take my word for it. The moat is as strong as ever. In terms of DUV, they control 90% market share there. So again, phenomenal over there. They're effectively the only business in the world that can make lithography machines. They're the best company to do it. And so naturally, conventional wisdom says that all else equal, the growth rate of the business, which has stayed about 20% earnings per share growth over the long term, and it's projected to do so in the future. That's based off the company's own guidance and additionally analyst estimates, which I tend to agree with. So company's growth rate stayed the same over the long term. Naturally, the upticks and downticks in valuation should come as a result of whether or not this company is becoming more predictable, more dominant in its industry, better suited and more durable for the future. If that's the case, if those qualities are increasing over time for the business, you would imagine that the valuation, the PE ratio, should go up. It should trade at a premium. It should trade at a higher and higher PE ratio because the company is more predictable and has a more durable moat. And so if we just simply pull the PE ratio, which isn't perfect, but we'll get a decent look into the valuation of the company over time, if we simply just pull in the PE ratio, and what I'm going to do is I'm actually going to zoom this in to roughly the 2019 period. And actually we'll go back 1 year. Because starting 2019 is when they really started to scale the EUV machines. And actually, you know what? Why am I telling you this? I could pull this up. If we do total EUV net system sales, you'll see that starting 2018, 2019 is when they really started to ramp up the production of EUV machines. And so the company fundamentally changed because historically they technically did have competition with the DUV sales, the less advanced machines that they were selling. But in terms of EUV, when they really started to scale that up and it became apparent that ASML is the only company that can do this, the company got re-rated to a higher valuation, and rightfully so, right? The moat became wider. It deserved that extra premium. And so if we look at the PE ratio over the past roughly 6 years, you'll see that at the bottom of the 2020 COVID crash, it traded at a 30 trailing PE. At the bottom of the 2022, when the whole market went down as a result of inflation and the so-called big tech recession, that type of stuff, again, it traded at roughly a 29, maybe 30 times earnings multiple. More recently, and actually in roughly September, October of 2023, again, we had a sell-off with ASML. I actually can't remember what it was off of. I didn't pay attention to the macro that much back then, but this is when I first initiated my position into the company at about $5.90 per share. The company traded at a 29 times earnings multiple. And you have to go all the way back to 2019 to find another time when the company was actually cheaper than where it is today. Again, based off of the somewhat flawed PE ratio, but I think it does a decent job of tracking ASML's earnings over time. I think the PE ratio in the case of ASML makes sense. And so to put that information another way, ASML today is the cheapest it has been over the past 6 years. I just moved the end of this chart about 1 quarter forward, but as you can see, since Q1 2019, which is about 6 years ago, today is the cheapest that ASML has ever been. And if we pull in, for example, an average line to kind of see the average historical PE that ASML has traded at during the 6-year period, it has averaged about a 42 PE. Now, I'm not suggesting that it's going to go back to that 42 PE, but the point still stands that the current valuation that ASML is being priced for is the most fearful, the most depressed valuation that this company has seen in its relevant history. And I'm not cherry picking the PE ratio. If you want to pull in something like EV to EBIT, EV to EBITDA, any relevant earnings multiple, and the picture is almost the same, or even in some cases, in the case of the EV to EBIT, I would argue this looks even better. It trades at a 5% operating income yield. Again, the cheapest it's been in 6 years. And so if you wanted even more proof that the company is currently undervalued relative to its history, the valuation metrics could, to some capacity, be skewed or otherwise be misleading. Maybe the stock is going to permanently be re-rated to a lower multiple, whatever the case may be. ASML themselves believe their stock is undervalued. Why else would they be buying roughly $3 billion worth of their stock? This is the second highest buyback that they've done in any quarter ever, only rivaled by Q4 2021 when they did roughly $3 billion of buybacks. And by the way, during that period, they just had a lot of extra money. So they weren't buying back because they thought the stock was undervalued back then. They were just over-earning in terms of their earnings at the time. But rest assured, I think this time around, they do genuinely believe that the stock is severely undervalued, because as you can see, during the 2022 period or 2021, it was a gradual increase of buybacks over a handful of quarters, but sequentially between Q4 of last year and Q1 of this year, you could see the massive, just sporadic, random increase in terms of the buybacks. And then to further drive my point, I actually ended up running my own scenario. This is actually the tweet that inspired this video. ASML is cheaper than a sack of potatoes. This is my Kager calculator that I personally made. And essentially you put 3 inputs in, you put your beginning and your ending year, and then based off that, you have a range of outcomes in terms of what the valuation of the company is going to be by your ending year. So over here in the yellow, I put an estimated 2.5% buyback, which I think is personally reasonable. And so actually I can demonstrate this to you again over on finchat.io. If we bring in the shareholder yield, which is actually, it's a mix of buybacks and the dividends that the company is paying, you could see that in the past, they have easily cleared that 2.5% mark, at some points even 3% or higher at 5% in 2022. So I think over the long term, they could easily clear that 2.5% mark. Then if we bring in 38% operating margins, they're currently at 32%. And at the peak profitability that this company had in 2021, it was at 35%. So actually, sorry, it's at 34% as of the most recent quarter. I'm saying there's a bit of inherent operating margin expansion that comes with the business model and them being able to increase prices over time and that type of stuff, new efficiency gains over the next 5 years. I don't think 38% is that aggressive of a target. But then in terms of the revenue growth, I chose the lowest point of their own guidance. So they've said by the year 2030, they expect to do between $44 billion euros and 60 billion euros of revenue. They say it right here. And then they say gross margin of between 56 to 60% and annual sales of between 44 to 60. So if we take the lowest point that they gave us, we take that 44 and you do 44 divided by what they're making today, that translates to a 9% revenue growth rate at the literal bottom point of their guidance. And so if we put all 3 of these inputs until the year 2030, and at the time I tweeted this, they traded at 23 times operating income. It's even less now. They're at 20 times operating income. So we say valuation stays flat and very conservative assumptions. you still end up with about an 11% stock return over the next 5 years, which is, beating the S&P. And might I mention, these are very, very conservative estimates over on my spreadsheet. And so instead of that 9% lowest point, most conservative point of their guidance, let's choose something in the middle. So on the highest end, if they were to achieve 60 billion, they would be doing about 16% revenue growth rate until 2030. I'm going to just go with 13 here. So again, somewhere in the middle there. I'm going to leave the operating margins at 38. And I'm also going to, I'll actually decrease the buyback yield. So we're only going to do a 2% buyback yield. On the low end, if the multiple of the company goes down, you still end up with a 15% stock CAGR until the year 2030. Now, let's just say that we had a bit more of a optimistic scenario. Let's say the company goes to 30 times operating income, which it has traded at many times over the past handful of years. Even as recent as January, February of this most recent year, so only a couple months ago, it was trading at roughly 30 times operating income. If the company returns to a 30% operating income, you end up with a $2,160 stock price in the year 2030. That translates to roughly 23% per year in terms of stock returns. And so there you have it. ASML is cheaper than a sack of potatoes because this is not like a sort of I guess it is cyclical. This is not like a narrow moat business that is supposed to trade at these cheap valuations. As you could see with the historical valuations that it tends to trade at, this is a company that trades at a fat premium. And it's supposed to trade at a fat premium because it has an unbelievably wide moat. It probably has the widest technological moat in the market today. This is a company that is probably decades ahead of its competition and has an unbelievable growth profile. In terms of just the pure growth profile, if you look at, for example, the average revenue per EUV sold, this is, by the way, a custom metric, which actually, you know what, I will show you. This is the formula for it if you want to make it at home using finchat.io. But if you just simply look at the price increases that they've done on these machines over time, unbelievable. I mean, you're deriving about 12% revenue growth, at least on this front of the business, just purely through price increases, not to mention the fact that the chart I showed earlier in the video of they've gone from about 15 EUVs sold in 2019 to selling, I think, about 50-60 of them today, and they're projecting that they're going to be selling hundreds by the end of the decade, perhaps. So just the organic growth from just price increases, and then you do any amount of volume growth from selling more machines, and then of course you got to service those machines over time. There's software upgrades that they could do. So it's just a truly incredible company in terms of growth profile, being able to pull on all these different levers to drive incremental growth. And ultimately, it really doesn't matter if there's one bad quarterly report where they miss revenues or they're a little bit uncertain. Our customers are a little bit hesitant. They might not buy this year. They're going to buy next year. You do realize that if they don't buy this year, that means that they're going to buy even more next year because there's a secular demand for chips and more semiconductors in the world. It's not like TSMC is going to sit there all of a sudden, you know what, we're done investing. That's it. We're ASML, we're good. We're good with all the machines we've bought so far. Thank you very much. No, they're going to continuously build new fabs. They're going to buy more machines. They're going to buy more equipment. They're going to buy more equipment from adjacent businesses. You got your Lam Research, your KLA Corp, Applied Materials, all these companies with adjacencies to ASML. They're going to be making more fabrication plants, and there's going to be more semiconductors in the world, just purely based off of the world is growing in terms of technology. That's it. Simple as that. If you're bullish on the world and technology as a whole, you're also bullish on ASML. That's, if I were to boil it down to one sentence, it's as simple as that. The company's trading at a 6-year low in terms of valuation, in terms of just pure numbers and, looking at modeling the future and that type of stuff. Again, looks absolutely incredible with very conservative estimates. You're looking at outperforming the market by a considerable margin. And so with that, ladies and gentlemen, thank you for watching the video all the way through. Not financial advice, of course. And I did want to watch through this of just, ASML's moat and do a couple minutes. This is Chit Chat Stocks podcast, exceptional podcast. I'll just link it in the description if you want to watch this afterwards. At about 13 minutes here, Leandro, which is the guest on the show, he's talking about the moat of ASML ultimately comes from not even achieving the technology. That's one side of the equation. But then at the same time, being able to manufacture these machines at scale and have them print wafers at scale, that's ultimately the advantage. Because in theory, these Chinese companies, they can make 5-nanometer machines and they can figure it out and the light source and all that type of stuff. The bigger challenge ultimately is the ability to manufacture, I don't know, it's like 5,000, 10,000 of these a day, something ridiculous. So I would recommend you watch this if you wanted an extra qualitative look into ASML.
Has achieved 5.
Again, thank you very much for watching. Link in the description for finchat.io. You have absolutely nothing to lose by just trying out the website. Again, 2 weeks free, no card required. As long as you have a valid email address, you could try out this beautiful stock research platform and gain access to all these different fundamental metrics and the charting capabilities of FinChat. Thank you for watching and have a great day.